It's just gone 1 minute past 6 here on Classic 1027. That means it's time for our weekly investment feature. And I've got Jameel Ahmad, Global Head of Currency Strategy and Market Research at FXTM, in studio because he's in the country, usually talking on Bloomberg Malaysia or Dubai Eye Radio or CNBC Arabia. So great to have you back in the country. Jameel, how are you doing?
Thank you very much for having me. Firstly, it's a pleasure to be here, and building long-term relationships is very important with FXTM, and it's a pleasure to be back in South Africa.
So much to talk about. We've got this historic Korean summit coming up, their trade wars, the resurgent dollar. But let's start with the impact of President Trump's trade policies, especially on high-yielding emerging market currencies like the rand. We have seen the rand take a bit of a battering over the last 48 hours. What do you think the saber rattling over trade battles, shall we call them at this stage, I don't think they're full-blown wars yet, is going to have on emerging market currencies?
Certainly a very unpredictable news flow, and investors are always needing to keep on top of the latest headlines because they're changing day to day with the unpredictable nature of US administration. So these Trump trade war headlines and that very aggressive narrative that he's going to start a trade war or he's going to impose high tariffs and so on, definitely keeps investors on guard. The biggest risk this has with emerging market currencies and emerging markets is that it should, in theory, really weaken risk appetite. If you have less risk appetite, you're less likely to be encouraged towards taking on risk, which is then where you have the impact on emerging market stocks and currencies. The South African rand is at a double threat actually to this, because it's not only is it a emerging market currency, but it's also one of the highest volatile currencies in the world. And despite South Africa looking very isolated on the map from US and China, US and Russia, or US and North Korea, if investors develop a risk-off approach, there's a lack of buying interest in the South African rand, and it can fall very heavily. We've seen that strengthen the dollar over the past 48 hours, and obviously we've seen the negative impact this has had on the South African rand. It's not only the rand, developed currencies like the euro, the British pound, and the Japanese yen have slipped, but the South African rand has also taken a nosedive as well.
And if you look at it against that broader emerging market currency basket, we had actually been one of the outperforming emerging market currency stories of the year. Obviously there was a lot of catch-up, and with the political narrative changing in December, a lot of that was being built in. I want to get your opinion on this 3% treasury yield level, which does for me look more psychological than anything else. As I was chatting to Nadia, talking about from 2.98% to 3 is not all that much. So why is all the focus on 3%?
I agree with you actually. It's more of a psychological and a technical level, and that's why the market's been on guard about this. Look, so the US Treasury yield has apparently broken 3% about 1 hour and a half ago, just as I was leaving my hotel to reach your interview, and we did not see that much of a significant move in the markets yet. The biggest fear was that once it did break 3%, and of course we should never say never because it could happen, it was going to cause some quite heavy volatility in the financial markets. It should have provided a big lift up for the dollar, which means that the dollar would have gone even further higher than it has over the past 48 hours, where it's hit its highest level in 3 months, and it's actually testing its 2018 highs, around 91, close to 92, if I remember rightly. And so this is what investors were quite concerned about. It was going to raise a lot of buying appetite towards the dollar. Could potentially have been a big risk to global equity markets. In turn, it could have provided a big risk to risk appetite. All of a sudden, investors do not want to take on risk. Global stock markets take a hit. The negative impact this would be on local audience is that the South African rand should, in theory, have taken a hit as well if that headline was correct. But so far, markets look quite calm, and it has broken 3%. And although it's quite a big psychological level, we're not seeing that much movement as of yet.
If things stay like they are for South African investors, we've also got the oil price hitting new high, $75 today. With a weakening rand, that doesn't bode well for our inflation, which from the last print is at a cyclical low. We printed 3.8% the last time round, so at the bottom end of the SARB's guidance between 3 and 6%. That said, though, it does look like inflationary pressures are really starting to build back up in the South African economy.
Exactly. This is one of the concerns, actually, that although higher oil prices is a very good thing for oil exporters and the commodity exporters, it could bring some quite unexpected inflation risks, because nobody was really expecting oil prices to hit $75, $80 quite yet. It was forecast to potentially happen later this year, maybe into the turn of 2019, but it's happened much sooner than the market expected, which can happen. So the concern this would have is that it's going to lead to an increase in global inflation pressures, which means that some central banks are going to become more upbeat than we had thought. This might also put a limit potentially on the bias from the South African Reserve Bank, where it did appear that they were going to resume an easing cycle where they continue cutting interest rates. However, the rand weakness over the past couple of trading sessions, if that continues, and if these inflation expectations do unexpectedly rise again, it could limit the scope on the South African Reserve Bank to cut interest rates, although it likely would be a positive move for the domestic economy.
The domestic economy is really front and center this year, with the rise of Ramaphosa and the new president, obviously a lot more market friendly, a lot more pro-business, with his background having really understood the thorny economic issues in South Africa. He's come out with this plan to raise $100 billion, 1.2 trillion rand. He's got his investment envoys, his pack of lions, as he calls them, to go out and secure these investments. We're almost 3 months into the Ramaphosa presidency. How is the market viewing Cyril Ramaphosa so far? Do you think that the so-called Ramaphosa is still carrying him along, or is he going to have to start delivering on some more tangible policy and structural reforms?
Well, the market's certainly more optimistic. If you look at the performance of the rand this year, one of the factors behind the rand rally into its highest levels since early 2015 was this political change. There was other contributors as well. We had a lot of risk appetite in the markets. Global stock markets were hitting record high after record high, which means investors were more encouraged to take on risks. That helps the rand. And of course, the dollar hit its milestone lows late January, early February, where it hit its lowest level since 2014. This helped the rand momentum as well. You could say there's improved sentiment in the air. This is my third visit to South Africa over the past year, and people certainly appear more upbeat. But to be honest with you, time will tell, because it's only 100 days, and whenever there's any kind of political change or any election, no matter whether this is in the United Kingdom, Europe, the United States, or wherever it might be, it always takes time for new policies, new political figures to actually have a tangible impact on the local economy.
A very important point to consider, that the general election is coming up next year, and we already see the public sector unions putting some pretty outrageous wage demands on the table, and that is probably the biggest single line item fiscal threat to South Africa's path of fiscal consolidation that we have to follow to appease the ratings agencies. And another big issue on the horizon, we managed to avoid a ratings downgrade the last time out, but that really just bought us some breathing room. We now need to start to see that real economic growth coming through if we're going to avoid a cut in the future.
The data certainly got better, and South Africa exited its short technical recession late last year, and there is room to be optimistic over the South African economy, that it has turned the corner, that it can catch up with its regional peers and some of the momentum we've seen in the advanced economies over the past couple of years. However, when you have such uncertainty and perhaps maybe a little bit of unease among some people, it can linger and it can cause an impact on the market. However, any one day of a strike such as what's going to happen tomorrow, it shouldn't have that much of impact on the economy, as long as a one-day strike does not turn into longer and then longer, and all of a sudden you have a more uncertain situation.
Jameel Ahmad, Global Head of Currency Strategy and Market Research at FXTM, with his view on the markets, on geopolitical risk, and Ramaphosa here on Classic Business. Jameel, thanks for your time.
Thank you very much for having me.